Hello, and welcome to your tax planning breakdown. This is based on the plan for Jeff and Valerie Edwards, and let's get started. So, why is tax planning necessary? It is an incredibly vital part of your financial plan. Without the proper preparation and planning, you can end up spending thousands of dollars in unnecessary taxes, and that's really what we strive to avoid with our analysis and our recommendations. Um, Different things are going to be taxed different ways and also for different reasons. So here is a breakdown of what you can expect when it comes to taxes. Other than your income, um, the largest portion of taxation is going to come from growth on your different investment accounts. So there's three main accounts. We've got taxable accounts, tax deferred accounts, and then tax-free accounts. So let's talk more about those. Taxable accounts, such as the brokerage account that you have, are taxed based on if your investments increase in value or if you receive dividends for those investments. This is where the terms short-term and long-term capital gains come into play. You can also have a loss on these types of investments, and those will be what you claim on your taxes when it comes time to do your taxes. You'll get a statement after the end of the year to tell you if you had any growth or loss or anything like that, especially if you withdraw any money. Um, well, definitely when you withdraw money, when you realize that gain, um, is when you'll be taxed on it. And then the way that you're taxed on those gains is based on how long you've held that investment. So if you have a short-term capital gain, that means that you had growth on an investment and you held it for less than a year. And if you have long-term capital gain, that means you had growth on an investment and you held that for longer than a year. So short-term capital gains are taxed at a much higher rate than long-term, and it's always going to be based on your tax setting or your bracket. So right now you're in the 22% bracket, and that would have an effect on how your gains were taxed. The next type is tax deferred. These are the accounts, mostly retirement accounts through your employer. So your 401k and your traditional IRAs. These are what you contribute to with pre-tax dollars, meaning that your account contributions come from your paycheck before your taxes are calculated for your income. So it'll be your gross pay, not your net pay. Um, the thing about these is you don't pay taxes on them until you begin to make withdrawals, and then it's taxed on your current tax rate, so whatever you're at when you begin to make withdrawals. It's also important to note that any withdrawals before the age of 59 and a half are going to be subject to a 10% penalty plus those taxes of your current tax rate. So unless they're for qualified purchases, which those are all listed out in your plan, then you'll have that 10% penalty fee. Tax-free accounts are, you know, kind of tricky because despite the name, you definitely pay taxes with these. Uh, your contributions to these accounts are going to be made with your income after you've already paid income taxes on them, and um, this means that uh, your money grows tax free, and you take your distribution straight out during retirement because you've already paid those taxes with your paycheck and your income taxes. So, a great example of these types are your Roth IRAs, which you both have and are contributing to. Currently, your tax situation, you're filing jointly, and you're in the 22% marginal tax bracket. And then, based off of your taxes for 2019, you've got about $20,000 that you pay a year in taxes. It's important to remember that once you retire, your tax obligations in your bracket are going to change. You can be taxed on your Social Security, but it's only up to 85%, and it kind of depends on if you have any other income coming in, if you're still working part-time or things like that. But since we have you both not drawing Social Security until age 70, you shouldn't have an issue with that because by that point you'll just be living off of your retirement and not working at that point. Your military pension isn't going to have any effects on your taxes either. And so that's always Nice. And just one thing to keep in mind is that we're not CPAs, and it's very important that you discuss all of our recommendations and the consequences of those recommendations with your CPA for a full analysis of the consequences of those, just to kind of run it by them. That's what they do strictly as taxes. So it's always a good idea just to double check and make sure that it's something that you think will be in your best interest to do.